Good morning, everyone, and welcome to MoneyCorp's Market Pulse webinar. It's great to have you with us. Our focus today is on the shift that we're seeing in markets away from economics and towards politics, and why that may matter in terms of the direction for interest rates and for foreign exchange markets. For a long time, markets have largely been driven by economic fundamentals, whether that's growth or inflation, or indeed interest rate differentials. But increasingly, we're seeing political risk driving market moves and really taking center stage. And we're seeing that play out across multiple fronts, whether that's the ongoing tensions in the Middle East, the Ukraine Russia war that's entered its fourth year, the volatility that's driving in energy markets, and indeed the FX market movements that we've seen over the course of recent months since the beginning of the war in the Middle East back at the end of February. And at the same time, the economic picture isn't giving us clear direction, which is why I think we're looking more towards politics to see whether there are any major changes there. There are some difficult trade-offs for central banks. There are also difficult trade-offs for governments. And the FX markets are struggling to break out of what are relatively tight ranges. So today we'll step through what's driving that dynamic, looking at growth, inflation, interest rates, politics, and geopolitics, and most importantly, what it means for the FX markets and those factors that are driving businesses across both domestic and international markets for the coming months. As always, the session is about helping you frame the risks and opportunities. And so there is the opportunity for you to ask questions. We have had some pre-submitted, but if you would like to submit, then you can do so in the chat box. Worthwhile noting, however, that the comments box will make your comments available to the entire audience. So without further ado, let's get on with the presentation. And as always, I'll just walk you very quickly through what we're going to talk about. So we're going to look at growth first and foremost, and is Q1 as good as it gets? Then we'll look at inflation and the developments there. I think we have seen some important developments, whether we're talking about major or indeed emerging market economies. Then we'll look at interest rates, who will hike, how much they'll hike by, and whether or not the markets are framing the debate on interest rates fairly or otherwise. Then we'll look at politics, and it's particularly interesting about what's going on in the UK at the moment, so I'll focus centrally on that. Then we'll look at geopolitics and the developments predominantly in the Middle East before turning our attention to the FX outlook. So without further ado, growth. Is Q1 as good as it gets? In a sense, for some economies, most likely the answer is yes. I think if we look at the UK and also Japan, the growth rates that both of those economies managed to produce over the course of Q1 surprised many. And I think with regard to the UK, there is perhaps, and I say perhaps because we're uncertain on this, there's perhaps some seasonal adjustment problems with regard to the data. We've seen this in previous years, in 2025 and in 2024, where the first quarter was very robust, and then we saw growth dropping away over the remaining quarters. And I think 2026 could easily be the same sort of thing. And with Japan, they've got headwinds as far as the rise in energy prices. They're a massive energy importer, so that's going to be problematic. And on top of that, they have a persistently weak yen, which might require the Bank of Japan to be more aggressive in terms of monetary tightening. For the US, we're not sure whether Q1 is the best that we're going to get, but certainly the second quarter is going to be somewhat, or going to have been somewhat more challenging because of the impact of the war in the Middle East on energy prices. And we've also seen a slowing in the housing market. So some problems there as far as consumer spending is concerned. And if we look at Europe, well, they're battling a number of headwinds, not only the big energy price rises and the big increase in inflation and inflation expectations seen recently, but they're also battling against a backdrop where they're going to have to significantly increase defense spending, but at what cost to other areas of government expenditure. So I think all of these economies are struggling, and that's before we get to Canada, which seems to be pretty much a bit of a basket case at the moment, on the basis that not only do they have those headwinds that I've already spoken about with regard to the other economies, but they also have the potential for one of the states of Canada or one of the provinces rather, breaking away, with Alberta talking about moving away from Canada. So lots of problems there on the growth front. Now, if we turn our attention to inflation, problems definitely manifesting themselves there. And I think the first thing to point out with regard to inflation is lots of central banks previously have said they'll try and look through energy price shocks, as they did with regard to the energy price shock that occurred in 2022 with Russia's invasion of Ukraine. But they are focusing on what it means for core inflation and what it also means as regard the inflation expectations. And on both of those fronts, particularly in Europe recently, we've started to see a pickup. And that means that there are interest rate increases likely coming. That said, I think as far as the increases that we're seeing from the European Central Bank, they're still going to be limited, but possibly not as limited as the markets are currently predicting. I will get onto that a little bit later on. There are more complications if you look at other economies. If you look at the US, then they have certainly an inflation problem, but they also have a labor market that doesn't look in great shape. They've had weaker economic growth than they're used to, and investment does seem to be skewed towards AI, whereas other areas of investment seem to be struggling much more. In the UK, there's a similar problem, of perhaps a more sizable problem with regard to the UK's labour market, higher levels of unemployment that we're seeing, particularly around youth unemployment, and also reducing average earnings growth. Both of those things, I think, are potentially problematic. The ageing population, which is something that I've spoken about on a number of occasions, continues to cause issues as well. But equally as well, from a consumer standpoint, consumers have been faced with higher energy prices and higher costs of necessity goods, and that may well be limiting what they're prepared to spend on discretionary items, particularly big ticket items. So the inflation issues for a lot of economies, I think, will continue to manifest themselves and will in turn inform the judgments of central banks going forward. And we've got a raft of central bank meetings from the major economies starting next week, I think will be a good guide of where things are likely to head over the coming months and quarters. So if we focus on interest rates, the one thing I would say is that the challenge for central banks is, number one, how much they've previously reduced interest rates by, which probably puts a bit more emphasis on the European Central Bank to start to reverse course quicker than other central banks. So bigger rate cuts have come out of the European Central Bank than the likes of the Bank of England or the US Federal Reserve. And the only other economy that's probably seen the same sort of scale of falls in interest rates, in fact, probably a little bit larger fall in interest rates, is Canada. But there I've already outlined some of the economic challenges that Canada has. So I think the European Central Bank will be first to hike, and that hike will come at next week's meeting. It'll be 25 basis points in all likelihood. And then the attention will turn to, well, what's going to happen in the third quarter? What's going to happen in future quarters thereafter? And the idea that the European Central Bank is going to be able to keep a lid on the inflationary pressures that have been driven by the war in the Middle East, I think it doesn't stand up to scrutiny. I think that if they are going to raise interest rates, then 2 interest rate hikes, which is broadly speaking what the markets have got priced for, slightly more than that, but they've got 2 definitely priced in. That's not really going to cut it. I think European rates would have to rise to somewhere in the region of 3%, if not slightly above that, in order for it to make any real difference to inflation and inflation expectations. If we look at the Bank of England, at the moment we're pricing in around about 2 rate increases, albeit we're not pricing in the second rate hike in its entirety just yet. But that case for higher interest rates was again made by resident hawk on the Bank of England's Monetary Policy Committee, Megan Green, who talked about this move away from the target rate of inflation and the potential increase in inflation expectations. So a lot of emphasis from the Bank of England there, or one member of the Bank of England's Monetary Policy Committee, on inflation and inflation expectations. Relatively little concern, it would appear, for the weakness that we're seeing in the labour market and indeed in areas of consumer expenditure. And then we look at other central banks. The US, with its new chair, Kevin Warsh, probably going to try and push back against any need for rate increases at this juncture. But we have seen, for example, from the Dallas Fed president yesterday, some arguments for higher interest rates based on the fact that inflation is diverging away from target and therefore becoming more problematic for the Federal Reserve, even though it's got this dual mandate. Apologies for that. I need to go back a slide there. If we look at what the markets are pricing for, I don't think that they're necessarily being sensible. As I say, I think given that some central banks cut interest rates much more aggressively, and they now have real yields that are in negative territory. In fact, the European Central Bank are currently displaying this to the tune of around about 1 percentage point. If you compare where the refinancing rate is versus where the headline inflation rate is, then that's clearly out of kilter with where they want to be. They want to be somewhat more restrictive or at least less accommodative in terms of monetary policy, which is why I think you'll get more than 2 rate increases, and that's why the markets aren't pricing in enough there. As far as the Federal Reserve is concerned, you can't look at this purely on the basis of economics because there is some political influence there. So winding in that whole idea of politics being somewhat more important than economics at the moment as far as foreign exchange market direction is concerned. And consequently, I think the prospects of rate increases are much more limited out of the US, if they even exist at all. So the markets are pricing for at least 1 rate rise, albeit not by the end of this year. But we did see a step change as far as interest rate expectations pricing was concerned after that speech by the Dallas Fed president yesterday. In terms of other central banks, the fact that we're pricing in anything for the Bank of Canada, I don't think is realistic. I think their economy is in real trouble. First quarter GDP numbers were the worst of all of the major economies in terms of economic performance, and the labour market has shown signs of distress in terms of labour market hiring dropping back, particularly for full-time employment. So I don't think the markets are being sensible. I mean, if there's an analogy, it's a bit like me when I go up and watch football at my favourite ground in the country, Ellen Road, and I've always got a huge amount of optimism as far as the expected result is going to be, no matter what the football team we're playing are. For the macroeconomic situation, it's a similar situation here. You cannot ignore the domestic headwinds that these economies are facing, and you cannot ignore the challenge that some of these economies have because their interest rates are in a different place to where other countries or economies' interest rates are. So I think that's going to be one of the major challenges as far as excuse me, as far as central banks are concerned, and reading central bank sentiment and intent over the course of the coming months and quarters. Now, getting on to the politics side of things, well, we've had several things happening in the UK recently, and none of them have been great for the government. So start off, well, quite a while back now. It doesn't feel that long ago, but it actually was quite some time ago. We had the Gorton and Denton by-election, which the Greens won and took away from the Labour Party. That was, I think, one of the catalysts behind the potential challenge to Keir Starmer's leadership. We then had local elections and regional elections in May. Those happened after the last webinar that we held. The local elections, they were pretty dreadful. They were dreadful for the Labour Party. They were dreadful for the Conservatives. They were brilliant for the Reform Party, the Greens, and also to a lesser extent the Liberal Democrats. So in terms of what that means, it potentially put increased pressure on Keir Starmer and the Labour Party and the government to try and enact change much more quickly than they appear to have been able to do. Then we look at the Welsh elections. I mean, in Wales, the Senate has been run by Labour since it was set up in 1999. They were then pushed into third place behind Plaid Cymru and Reform, and they lost the bulk of their seats within that election. They had a dreadful result in Wales, and they also had a dreadful result in Scotland, which after the general election, for a short while at least, they look as if they would have been running Scotland and the Holyrood once the elections were held in 2026. The SNP have won a fifth straight term. They only lost a small part of their vote share and a fraction of the seats, whereas other political parties did poorly, again with the exception of Reform, who picked up quite a number of seats. So overall, the political situation in the UK, I think, is going to be increasingly challenging. And it will be increasingly challenging in terms of the risk is in Westminster. There could be a lurch to the left if Keir Starmer does face a leadership challenge, which looks increasingly likely. That lurch to the left could manifest itself in terms of higher borrowing, higher spending, or higher taxes. I don't think any of those things would be necessarily positive in terms of the medium-term outlook for economic growth. And equally as well, I think the pressures for another independence referendum in Scotland are likely to rise again, because the number of political parties and the number of seats held by those political parties that are arguing now for Scottish independence would suggest that there is enough of a groundswell of opinion to take this to yet another vote. So the once in the generation, well, if a generation lasts around sort of 12 or 13 years, then we're into the potential for another Scottish independence referendum, in my opinion. And both the potential for a leadership change in Westminster and the potential for a Scottish independence vote could be quite negative for sterling going forward. But if we look at the geopolitical situation, then we keep getting close to a deal as far as the US and Iran is concerned, at least if you believe what you're hearing in the press, but we never get there. And I think I was encouraged today by the fact that the Israelis and Lebanon have talked about renewing their ceasefire, but only if the Hezbollah terrorist organization backed by the Iranians stop attacking Israel, which I don't think that's likely. There are other conditions around this as well. So I think it's a very, very fragile ceasefire between Israel and Lebanon, and I'm not sure it will hold, given the propensity that we've seen for further military attacks and incursions. Equally, as regard the US and Iran, whilst they were talking about holding further talks and getting closer to a deal, they were also exchanging fire. So the US attacked a command and control facility in Iran, and the Iranians launched a number of missile and drone strikes on neighboring states. I think all of this is problematic in terms of what it means for economic activity going forward. And the geopolitical situation in the Middle East is fraught with danger, and potentially the situation is becoming less rather than more stable. The other big thing is, even if they came to an agreement and a memorandum of understanding, does that mean the Strait of Hormuz will open immediately, or will it require several weeks for mine clearing and other things to happen in order for safe transit of shipping through the Strait of Hormuz, so getting energy supplies moving again? I'm not convinced that we are in a position yet to think that a deal is close. And it was interesting listening to some of the comments that we got from the US president, where he talked about the Strait of Hormuz potentially being clear for transit by September. Now, that's still 3 months away, basically. So that still creates some potentially significant problems, and again, headwinds from a macroeconomic perspective. So getting on to the final slide, FX forecast struggling to break out of ranges. We've seen relatively little movement in FX, and there's one exception, which is we have seen repeated quite large swings in dollar yen, prompted by a number of comments that we've seen from the Bank of Japan or the Ministry of Finance, or the fact that there's the suggestion that they've been checking rates around the marketplace. But other than that, sterling dollar, euro dollar, and sterling euro have been trading in relatively tight ranges. I do think that the political problems that I've already mentioned in the UK could produce some downside risks to sterling. As far as the Middle East situation, I don't think it will be resolved soon, so that potentially puts some upside risk into the US dollar. Canadian dollar, talked about the USMCA review that's due in the summer, but on top of that, the economic weakness I don't think is favourable for the Canadian dollar at this juncture, so you could see additional weakness there. And then other currencies are also causing problems. And the Swiss franc is one that I will call out here, which is potentially going to create prolonged disinflationary or deflationary risks for the Swiss economy. And that's something that they don't really want. They've suffered that before. They suffered that for the best part of sort of 10 years post the financial crisis, and it created all sorts of economic problems for the Swiss economy. So it's the last thing that they need at this juncture. But in terms of other factors that are likely to influence the FX markets, I think we will continue to see a focus on forecasts that we get out of the likes of the International Monetary Fund or the Organization for Economic Cooperation and Development. In fact, we got some updated forecasts only a day or so ago from the OECD, and everybody seemed to latch on to the fact that the UK forecast was upgraded. Yes, it was. It was upgraded from 0.7, which is a pretty dismal forecast for UK growth, to 0.9, which is still a dismal forecast for UK economic growth. So it's not as if we're saying that things are looking so much better. They're just looking less bleak. But at the same time, that 2026 forecast was counterbalanced by a downgrade to 2027 growth expectations, down from 1.3 to 1.1%. So overall, you're not really getting anywhere. It's a bit like the animal in the original Dr. Dolittle movie, the push me pull you. Like the forecasts are basically pushing and pulling in different directions, depending on what time horizon you focus on. Overall, that makes it very difficult to navigate the foreign exchange markets. Makes it very, very difficult to understand what the key factors influencing FX moves are. But I do think politics will create greater and greater headwinds where those political problems are most likely largest. And that's why I focus again on the UK and some of the issues that are liable to raise their head over the course of the coming months. So that's the end of the formal part of the presentation. We're going to switch quickly on to Q&A now and answering your questions. So we have had some pre-submitted. I noticed that there's none on the comment box at the moment, but there is still time. So the first question is, what impact might an imminent new PM and or Chancellor have on bond and FX markets? Well, hopefully I've already kind of answered this in terms of that. I think that it will mean a lurch to the left. I think it's almost inevitable if you're moving away from the Starmer and Reeves dynamic duo. Can I call them that? I'm not sure, but if we move away from them and we move to somebody like Andy Burnham, then I think some of the things that he has said already during his campaign in the Makerfield by-election, which is due on the 18th of June, would suggest that he's looking for not a lurch, but certainly a step more leftward as far as the political direction of the Labour Party. And I don't think bond markets will react positively to that. So I think that has the potential to raise bond yields even further. And as far as foreign exchange markets are concerned, now normally if you have higher bond yields across the curve, that ought to be supportive if they're moving disproportionately to where other markets are moving. But as we saw with Liz Truss back in 2022, that's not always the case. And I think with this case, it will be the fact that the markets don't like the potential new direction of travel, which means that sterling heads lower. Trying to quantify that's quite difficult, but I think you could easily see bond yields rising by 10 to 15 basis points across the curve, more towards the medium and long end, or bigger moves towards the medium and long end of the curve. And with regard to foreign exchange markets, sterling dollar could fall down towards 131, we're currently at sort of 134-ish at the moment. And as far as sterling euro is concerned, I'd be looking for it to head into the very, very low teens, or even the sort of 112s, 111 region, on the back of a change of political leadership in the UK. So hopefully that answers that particular question. Number two, I think everybody's quite gloomy at the moment by the looks of these questions. Is the US dollar likely to crash in the next 12 months? It's very difficult to give a definitive answer. I think there are some reasons why I would say no. One of those is I think the midterm elections are likely to rein in whatever prospects you're going to see for more trade and tariff movements from the US president. He could lose control of the House of Representatives and also lose control of the Senate. So I think there's going to be more scrutiny put on by the other arms of government onto the US administration than has been thus far. So that's one of the reasons why I don't think that the dollar will crash, because I think that the ability of the administration to do anything radical is going to be removed, or at least reduced. And I do think that even if we get a resolution to the war in the Gulf, I think the economic problems that creates for Europe and the UK, using those two economies separately, are larger than the problems that we're likely to see manifest in the US or other geographical jurisdictions. So the dollar's performance against the euro and sterling is unlikely to be materially different to what we've seen thus far, and it might actually get a bit stronger, in my opinion. What would cause a crash would be some sort of reset as far as expectations over AI investment and also the payoffs to that investment that could cause a revaluation of tech companies. I don't see anything at the moment that would suggest that that's going to happen. Equally, concerns over private credit, and that market's worth around sort of $3 trillion. It doesn't just affect the US. The private credit market has tentacles in a lot of different macroeconomic regions, so I'm not sure it's just a net negative for the US if it were to worsen, which there doesn't again appear to be signs of that worsening or weakening thus far. So I just don't see why the dollar would crash in the next 12 months. And technically as well, if you look at technical analysis, there are a number of factors that are likely to limit any gains that we see from the euro, from the pound, or indeed the Japanese yen, the Canadian dollar, and a whole host of other major currencies against the US dollar. The only area that I'm still struggling with is why the dollar is performing so poorly against the Chinese renminbi. The numbers out of China appear to be getting better economically, but this is set against a backdrop where global trade is very, very tricky at the moment, and I'm not sure how China is going to navigate that successfully. So that might be one area to revisit over the coming months and quarters. So I think China may well actually be storing up problems for themselves, and that might be another reason why the dollar, rather than crashing, actually appreciates in the next sort of 6 to 12 months. And then the final question that we have is, in your opinion, what are the 2 to 3 most important factors that could put the US dollar under significant pressure by the end of the year? Okay, number one, clearly a resolution in the Middle East war. I think if that were to reduce the headwinds to economic growth for Europe in particular, but also to parts of Asia, then that could put the dollar under a bit of pressure. But that would assume that transit through the Strait of Hormuz reoccurs relatively quickly thereafter. The second thing I think is with regard to the sort of AI bubble that we're seeing at the moment, can that be sustained? Can the US equity markets continue to print new highs? I think that is that's a challenging environment, let's put it that way, given some of the valuations that we see for those companies. So that could be another factor. Another factor as well is the the US housing market, which had been staging something of a recovery, but with yields increasing as much as they have been over the course of recent months, I think that housing market recovery could be choked off. And that has then a net negative effect onto US consumer spending as well. So I think all of those things could put the dollar under significant pressure by the end of the year. But there are those counterbalancing factors that I've already mentioned. So we don't have any further questions. All it leaves me to do is thank you very much for your time and attention today. I hope it's been a useful session. I hope you got the Leeds United reference. If you don't, I'm afraid there are going to be more. So, we're going to take whatever benefits we have of still being in the Premier League for as long as we are. Please, if you wouldn't mind, there will be. There is a QR code on your screen right now. Take your time to fill out the feedback. It only takes 2 minutes of your time. We really appreciate it. And also, you get your say in terms of what you'd like to hear about as well. Remember that the teams are always on hand if you've got issues that you want to discuss. If you want further market insight from myself, anything feeding into budgets or budget alterations for the remainder of this year and into 2027. So do feel free to reach out to your usual contact or contact us directly on the numbers on screen. Leaves me to wish you a very successful month ahead and hope to see you again next month. We hope you enjoyed the new format as well, and any feedback that you have on that will also be very useful. But thank you very much for listening. Have a great day, and we'll see you again next month.